All right, let's get right into it. Today, we're diving deep into the empty spaces on your trading charts, these really powerful signals called liquidity voids. Now, these aren't just random gaps. They are essentially hidden clues that fast money leaves behind, and they tell a fascinating story about imbalance and, you guessed it, opportunity. So let's break this down. I mean, just think about that for a second. In the middle of all the market chaos, what if the most aggressive one-sided price moves actually created a predictable pattern, a kind of vacuum that price just feels compelled to go back and check out? Well, that's exactly the idea we're digging into today. How we can turn what looks like market efficiency into a really powerful analytical tool. So here's our game plan. First, we're going to look at what even creates these empty spaces. Then we'll nail down the definition of a liquidity void. And, this is the big one, why the market seems to want to fill them. After that, we'll get practical. How to spot them, how to analyze them, the different types you'll see, and we'll wrap it all up with the key takeaways. All right, first up, the market's empty spaces. So when you see price just take off, move with incredible speed and force, it's leaving something in its wake. This isn't just a strong trend, it's more like the footprints of an aggressive one-sided market creating this vacuum behind it. Think about it like this. When price just plummets in a series of huge red candles, where are all the buyers? They're not there. And when it rockets up, where are the sellers? They're gone. It's happening because the move was just too fast for most people to even react. And that creates these zones with super thin volume, or what we call inefficient price delivery. Okay, so let's give this thing a proper name. What is a liquidity void exactly? We need a really clear, actionable definition, so you know precisely what you're looking for, whether you're trading Bitcoin, gold, forex, you name it. So here it is. A liquidity void is simply an area where a super fast price move, traders call this displacement, creates an imbalance, and you spot it by looking for one or more big, fat candles, all moving in the same direction with tiny little wicks. Seriously, those short wicks are the key. They scream that there was almost no argument between buyers and sellers, and that is the very definition of an inefficient market. Now, this is a super important point because a lot of people get these terms mixed up. A liquidity void is the big picture. It's that whole aggressive move. Now, inside that void, you might find a few fair value gaps, which are a very specific 3-candle pattern. And a vacuum block, that's totally different. That's a literal gap where no trading happened at all, like you see at market open sometimes. So just remember, the liquidity void is the whole zone of imbalance. And this brings us to the million-dollar question. Why should we even care? Why does any of this matter? Well, in this next section, we're going to unpack the logic that causes price to get pulled back into these voids. And I promise, it's not magic, it's just pure economics. To really get this, let's use a simple analogy from a trader named Solomon King. So imagine you sell oranges. The fair price, everyone agrees, is $100 an orange. Business is good, the market is totally balanced. Then, bam, some crazy news hits and the price of your oranges just collapses. It goes from $100 all the way down to $5. That sudden, violent drop, that is our liquidity void. It's a huge, inefficient move away from what everyone thought was a fair price. So if you were the one happily selling at $100, you are now, as Solomon King says, in pain. And it's not just you. The big institutional players, the so-called smart money, they feel it too. They had positions based on a balanced market, and this sudden imbalance is a major problem they want to see get fixed. So what do you think happens next? The market hates a vacuum. Price is going to be naturally drawn back up towards that $100 level to, rebalance the books and offer prices in a more orderly way. This filling of the void is just the market correcting itself, and that's exactly why these zones act like magnets for price. Okay, so we've got the what and the why. Let's get practical. This is your field guide for actually spotting these voids on a live chart and building a framework for how to analyze what happens when price comes back to them. The process itself is pretty straightforward, but it definitely requires patience. First, you spot the displacement, that big explosive move. Second, you just draw a box around the whole zone from top to bottom. Third, and listen, this is a test of your psychology. You wait. You don't chase that first move. The real setup is when price comes back to that zone. And finally, when it does, you don't just blindly click buy or sell. You watch. You wait for a reaction. Does price reject the level, or does it just slice right through? And here's a little pro tip. The market doesn't always have to fill the entire void to be satisfied. A really common thing you'll see is price retracing to the halfway point, a level with the fancy name consequent encroachment, and then having a huge reaction from there. So that 50% mark is always a critical spot to keep your eye on. Okay, and this is so important. A liquidity void is a tool for analysis. It is not a crystal ball. So your risk management has to be on point. Never, ever enter a trade just because price touched a void. You have to wait for some kind of confirmation. And a pretty logical place for a stop loss is just on the other side of the void. And please remember, context is king. A bullish void that forms in a clear uptrend is way more likely to act as support than one that shows up out of nowhere. All right, let's add one more layer of skill to this. Just like not all trends are the same, not all voids act the same way. Where a void shows up in the bigger picture in the overall market structure tells you a whole lot about what it's likely to do next. This table breaks it down perfectly. Think of these as the 4 main personalities of voids. Common voids pop up in choppy, sideways markets, and yeah, they usually get filled pretty quick. Exhaustion voids happen at the very top or bottom of a huge trend, and they often signal, hey, a reversal is coming. Breakout voids happen when price smashes a key level. Often price comes back to fill it before taking off again. And then there's the runaway void. This is the one you gotta respect. It happens mid-trend, and it's usually a sign of massive strength, which means it probably isn't getting filled anytime soon. Whew, okay, we have covered a ton of ground. Let's pull everything together in this last section and boil it all down to the absolute essentials you need to remember when you're staring at your own charts. So here's the bottom line. First, liquidity voids are just signs of market inefficiency. Second, they're created by those powerful, fast moves on super thin volume. Third, because the market loves efficiency, price acts like a magnet, getting pulled back to these zones. And finally, and maybe most importantly, the context of the overall trend tells you everything about how that void is likely to behave. So, I'll leave you with a question to think about. Now that you can see these footprints in the market, how are you going to use this? Do you see yourself as the kind of trader who wants to catch the reversal as price gets pulled back into the void? Or are you more of the patient type who waits for the market to fix itself and then trades the continuation? There's no right or wrong answer, but thinking about it is the first step to making this powerful concept your own.